Okay, let's go through and label these accounts the way that they need to be labeled by starting at the top of the current asset sheet. The first T account is going to be the bank account. So just label that bank up at the top of that T. The second account will be accounts receivable. Feel free to abbreviate as much as you would like, okay? As long as you know what it means and you can read it. The next account is contracts in transit. Let's skip a couple T accounts here, and the next one make it inventory. Under fixed assets, we have one fixed asset account called furniture. Under the liability section, we've got one account called accounts payable. Next account is flooring payable. Let's go down to the last T account in the liability section and call that long-term loan. We'll skip over the accruals for this example. We'll be using those in the future, but let's skip over it for now and go down to the capital section. The first account is called owner's investment. Then we have earnings, which has other titles called profit and loss, net income. Has a lot of different titles that we could be using. We're going to use the earnings today. Okay? So when you're done, it should look something similar to this right here. Now we're going to go through and we're going to enter transactions into these T account sheets. The first couple we'll do together, and then I'll give you a chance to work it yourself, and then we'll go over each answer separately. Okay. The first transaction we have in our new company is to make an investment of $20,000 and put the money in the bank. Okay? Now, whenever you've got a transaction, we want to look for those two components. First of all, what is it we got? What is it the business got? And then, where did it come from? The debit is what we got. The credit is where it came from. So think through this transaction. If it were me doing it, this is my logic in this. I would say we got $20,000, didn't we? So that's a debit in the bank account, right? So we're going to debit the bank account $20,000 because that's what we got, right? Now, where did it come from? The owner invested it in the business, so we're going to credit owner's investment $20,000. Okay? Do our debits equal our credits? They have to. Okay? If they don't, we're not done. Always, the debits have to equal the credits. We've impacted two accounts in here. You might, in some transactions, impact 3, 4, 5 accounts in the same transaction, as you'll see today. We'll do that on occasion. But our debits will always equal our credits, and that must always be the case. No exception. Okay? Let's go to the next one. We purchased inventory. This is things we intend to resell. We purchased inventory for $10,000, and we told them we would pay them back in 30 days. And they said, okay. So think about what did we get? Think about where did it come from? I'm going to give you a moment to figure this out on your own, and then we'll go through the answer. What did we get? Where did it come from? Okay. We purchased inventory. That's what we got, right? So that's going to be the debit. And so we're going to debit inventory $10,000. Where did it come from? 30-day account, right? Do we owe it back? We do. Since it's 30 days, what account is it? Accounts payable. So we're going to credit accounts payable $10,000. Debit equals credit. We're done. Tammy. No. Flooring payable is only if we're buying something with a serial number that's expensive that we pay off when? When you sell it. So there's no fixed time frame. Hopefully it's going to be in the next week that we're going to have to pay it because we'll sell it. But whenever it's a 30, 60, 90-day account, then it's an accounts payable entry, okay? Entry number 3, we bought some more inventory, this time on an open line of credit, on that flooring line of credit for $20,000. So make the entry to record that purchase of inventory on the open line of credit for $20,000. Okay, I need some help here. Kathy, tell us what you did.
I debited inventory for $20,000 because we increased our inventory.
Uh-huh.
And I credited $20,000 to flooring payable.
Very good. Debit inventory, $20,000. Credit flooring payable, $20,000. Okay? And you notice that I'm putting numbers to the right of these. That's just to cross-reference them. And these become very important if at the end we don't balance. We need to go back in and figure out which one's out of balance. So if you'll just include the numbers to the side of it and put a circle around them so that we don't confuse them when we're adding them up with the dollar amounts, it will help you later on. Okay? Number 4. Okay, now number 4 requires a little explanation. Our purpose in business is to provide a service or sell a product. Whenever we accomplish that, we have earned something. Okay? So, in this case, we received $3,000 from a customer for services that we performed. We earned $3,000 from performing this service, and we put it in the bank. Okay? I use some key words in there. We earned $3,000 from this customer and we put it in the bank. Take your best shot. Okay, Harleen, what'd you do? Debited $3,000 to the bank and credited earnings $3,000. Remember that this earnings has different titles. Do you remember what some of those titles are? Profit, net income, profit or loss, net profit. I mean, there's just a bunch of different titles for it. Okay? We're using earnings because we earned it in this case. So, debit the bank, where did it come from? We earned it, $3,000 to earnings. Okay? Number 5. We completed another $2,000 job for a customer, but this time they didn't pay us cash. They said, we'll pay you in 30 days, and we agreed to that. So this time we're not getting cash, we're getting a promise from the customer that they're going to pay us that $2,000. We earned it, but we're not going to get it for 30 days. Okay. Carol, what'd you do?
Debited accounts receivable for $2,000 and credited earnings $2,000.
Very good. Debit accounts receivable $2,000, credit earnings $2,000. we earned money in either case, didn't we? In one case, we got cash now. In another case, we got a promise to get cash in 30 days. But regardless, we earned the money. Okay, it's done. The sale's been accomplished. We just haven't gotten it yet in that second case. Good. Number 6. We performed a $3,000 job for a customer. The customer gave us two things. He gave us $1,000 cash that we put in the bank, and he signed a contract for the balance of $2,000 that we're going to go down and sell to the bank. Okay? We haven't sold it yet, but it's in transit right now to the bank. Okay? So we got two things. We earned $3,000 for it. We got two different things, cash and a contract. Nikki, what'd you do?
I debited the bank account for $1,000.
Good.
I debited the contracts in transit for $2,000.
Good.
And I credited the earnings for $3,000.
Excellent. Okay. Do our debits equal our credits? Got 3,000 in debits. We got 3,000 in credits. Okay. We got two things: bank, $1,000 in cash, and a contract that we're going to sell to the bank. And then we got a credit to earnings because that's where it came from. Okay. Now, why contracts in transit? Why not accounts receivable? Because our intention is to sell it to the bank, not collect it from the customer, but sell it to the bank. If, in fact, we had said, I'll give you 60 days, no interest, what would it have been? Accounts receivable. We needed the money now, so we were going to sell it to the bank. Okay? Number 7. We had a desk and chair at home that we needed in the business more than we did at home, so we decided to give it to the business. Took it down to the office. It cost us originally several $1,000s for this desk and chair, but now it's only worth $2,000. So we're going to bring it into the books at $2,000. So show what we got, then think, where did it come from? Okay, Tammy, what'd you do? Great. Excellent. Debited furniture, $2,000. Credit owner's investment, $2,000. See, it doesn't matter if it's cash or computer or inventory or whatever it is. If it came from the owner, if the owner gave it to the business, it's an investment in the business. Okay? Number 8. Took out a loan from the bank, 3-year loan, and we put the proceeds of $10,000 into our checking account. So we borrowed $10,000 from the bank. We're going to pay it back over 3 years. Dixie, what'd you do?
I debited the bank account for $10,000.
Good.
I credited long-term loan for $10,000.
Good. Debit the bank account, $10,000. Credit the long-term loan, $10,000. Everybody get that? Questions on that one? Okay, now so far this is all we did this month was make these transactions. So now we need to total each of the accounts and provide the totals and make sure that the assets equal the liabilities and capital. Now to do that, we've made 4 deposits into the bank, right? How much do they add up to? $34,000. So write $34,000 in the blank space under the balance column. That says we got $34,000 in the bank right now. Is that right? If our records are right, that's right. We have $2,000 in accounts receivable. We have $2,000 in contracts in transit. We have how much inventory? $30,000. And we've got $2,000 in furniture. Now add up the total assets. $70,000. Okay, does someone else get that? Good. Okay, let's go over to the liability accrual and capital side now. The liability account, or accounts payable, we had $10,000. Flooring payable, we have $20,000. Long-term loan is $10,000. Owner's investment is $22,000. And earnings is how much? $8,000. Now, total up the right-hand side, all the way down to the bottom line, which says total liabilities, accruals, and capital. How much you get? Is that a coincidence? Absolutely not. What's that? Sometimes we feel that way when it actually works. Yes, a balance, because our debits, assets, our debit balance accounts equal our credit balance accounts, right? And they must be that way. If they're not that way, we've made a mistake someplace. And we have to go back in and figure out why that is. They must be in balance. Now, we got $70,000 then in assets. Where did those $70,000 in assets come from? On the other side, right? How much of it do we owe somebody? About $40,000, right? Okay. And the rest is down the equity. It was an investment by the owner, or we've earned it. Okay, that's our money. We don't owe anybody that money. That's either the profit or the investment from the business. Okay. Now this, in a different form than we typically show, is a balance sheet. It simply shows the balances in each asset account. We know in the bank account we've got $34,000, accounts receivable $2,000, and so forth. It shows us the same information that comes out in a balance sheet. So you've just created your first balance sheet, possibly.